Hello everyone. In this video we're going to be starting the very last chapter in managerial accounting, which is about capital investment analysis. So this is the last chapter we're going to be covering based on our syllabus or schedule of content. And we're going to be talking about capital investment and how we analyze capital investment from a business perspective. So the first thing we're going to start going over is the nature of capital investment analysis. So companies use capital investment analysis to evaluate long-term investments. That's the main idea of relying on capital investment analysis. And the word capital here refers to long-term assets, or to be more specific, fixed assets. So capital investment analysis, or capital budgeting as it's called sometimes, is the process by which management plans, evaluates, and controls investments in fixed assets. Capital investments use funds and affect operations for many years and must earn a reasonable rate of return. So capital investment decisions are some of the most important decisions that management makes. Because you're investing in a fixed asset, you want to make sure that you're doing the right decision and that this fixed asset is going to generate enough revenue that will cover its cost and generate more profit for you. So capital investment evaluation methods can be grouped into two main categories. There are methods that do not use present values, and there are methods that use present values. So within the methods that use present values or do not use present values, which is actually what we're going to be starting with, is the average rate of return method and something called cash payback method. So average rate of return method, which is trying to calculate the rate of return for that investment, and the cash payback method, which is how much cash can be generated out of this investment that would cover its initial cost. Then we have the methods that use present value methods, and this is going to be relying on the time value of money concepts. So we have the net present value method and the internal rate of return methods. So the two methods that use present value consider the time value of money, and the time value of money concept recognizes that $1 today is worth more than $1 tomorrow, because today's dollar can earn interest. So this is one of those things I want you to keep in mind. We're not really including inflation here, because many people might think the time value of money is based on inflation, but please put inflation on the side. We're talking about $1 today is worth more than $1 tomorrow. Is worth more than $1 tomorrow because today's dollar can earn interest, and that's the main idea of the time value of money concept. So now let's do a quick knowledge check. Which of the following capital investment evaluation methods does not take into account the time value of money? So I think we already talked about that. So we have the cash payback method. That's one of those methods. The net present value method and the internal rate of return methods, these are two methods that rely on the time value of money. The time value of money concept, that's not a method, it's a concept that actually relates to B and C. So the right answer for our question here for the method that does not take into account the time value of money is the cash payback method. So methods that do not use the time value of money are the average rate of return and the cash payback method. Methods that do not use the time value of money are the net present value and internal rate of return methods. So please remember that, because this is just the basic foundation for the idea of capital investment analysis. So now let's start with the methods that do not use present value. So the methods not using present values are often useful in evaluating capital investment proposals that have relatively short useful lives. So if we're thinking about a capital investment that doesn't have a long-term impact, then in this case we can rely on these methods that do not use present value. Because the methods not using present values are easy to use, they're often used to screen proposals. Minimum standards for accepting proposals are set, and proposals not meeting these standards are dropped or eliminated. So if a proposal meets the minimum standard, it may be subject to further analysis using the other methods that rely on present value. So let's start with the first method that does not rely on rate of return, which is the average, that does not rely on the present value of money, which is the average rate of return method. So the average rate of return, sometimes called the accounting rate of return, measures the average income as a percentage of the average investment. So in other words, to calculate your average rate of return, you have to divide your average annual income by the average investment. The numerator, which is the top value here, is the average of the annual income expected to be earned from the investment over its life. Of course, after deducting depreciation, because depreciation is not really a cash flow. So that's why we exclude it from that calculation. The denominator, which is the bottom value here, is the average investment or book value over the life of the investment. So assuming straight line depreciation, the average investment is computed as follows. We usually get the initial cost of the investment plus its residual value and we divide it by 2. And that's how we calculate the word average, which is basically beginning plus ending divided by 2. That's how I always remember how I calculate an average. It's the beginning plus ending divided by 2. The beginning is the initial cost, the ending is the residual value, and you divide it by 2. So let's see an example where we can apply the average rate of return method. So assume that management is evaluating the purchase of a new machine. The cost of the new machine is $500,000 or $500,000. It has a 0 residual value. Its expected useful life is 4 years and expected total income from the machine is $200,000 over the 4 years. So over the 4 years, it's going to be generating $200,000. So the average annual income expected from the machine is $50, which is the $200,000 divided by 4, and the average investment is $250,000. How did we get the average investment? Again, remember, beginning plus ending divided by 2. So it's initial cost plus the residual value divided by 2. So we get the $500,000, which is our cost of the new machine, plus the residual value, which is 0, divided by 2, and that's $250,000. So the average rate of return, you can see here that the average annual income is $50 because it's $200,000 divided by 4 years, that's $50,000, divided by the average investment of $250,000, and that's 20%. So the average rate of return of 20% should be compared to the minimum rate of return required by management. So say the management is requiring at least 15%. So in this case, the average rate of return is 20. So in this case, we are going to accept that the purchase of this machine. But what if management requires at least 25% average rate of return? So in this case, this machine is only returning 20%, which is below the 25%, then we're going to reject the purchase of this machine. So if the average rate of return equals or exceeds the minimum rate, the machine should be purchased or considered for further analysis. The average rate of return has the following 3 advantages. So it's an easy computation, as you just seen. It's not too complicated. It includes the entire amount of income earned over the life of the proposal. It emphasizes accounting income, which is often used by investors and creditors in evaluating management performance. The average rate of return has the following advantages. So it does not directly consider the expected cash flows from the proposal, and it does not directly consider the timing of the expected cash flows. So you really don't know when the expected cash flow is going to be coming. Now let's see the other method, which is the cash payback method. The expected period of time between the date of an investment and the recovery in cash of the amount invested is the cash payback period. So when annual net cash flow are equal, the cash payback period is calculated as follows. We get the initial cost divided by the annual net cash inflow. So let's see this example. Assume that management is evaluating the purchase of the following new machine. The cost of the machine is $200,000. The cash revenue from machine per year is $50,000. The expense of the machine per year, including depreciation, is $30,000. And the depreciation per year is $20,000. Keep in mind, depreciation is a non-cash expense because we don't really pay for depreciation. Depreciation is just the allocation of the cost of the asset over its useful life. So when the depreciation is $20,000 and our expenses is $30,000, we can say that the actual cash expense of the machine, excluding depreciation, is only $10,000. So we get the $30,000 minus the 20, and that would be $10,000. And that's the cash expenses related to this machine. So the revenue and expenses, other than depreciation, are assumed to be in cash. In other words, or hence, the net cash inflow per year from use of the machine is as follows. We get the cash revenue from the machine is $50,000 per year. The cash expenses of the machine is $10,000, which I just showed you how we got it. And looking here at the bottom part of the calculation, we have the expense of the machine including depreciation is $30,000. We subtract the depreciation expense of $20,000 because that's a non-cash expense. So the cash expense of the machine is only $10,000. So we take the $10,000, we subtract it from the cash revenue. So the net cash flow or inflow per year is $40,000. Now we have to compare this cash inflow to the initial cost and see how long it will take us to cover or get back the initial cost. So the timing required for the net cash flow to equal the cost of the new machine is the payback period. Therefore, the cash payback period for the investment is 5 years. So how we calculate that? The initial cost is $200,000, which is what was given to us here, the $200,000. And then the annual net cash inflow, which we just calculated here. So divided 200,000 by 40,000, that's 5 years. So it would take us 5 years to cover our initial cost. I don't know if you noticed, but we didn't make any kind of attention to the time cost of money. So we are just assuming there's no interest or anything over these years. We're just purely comparing the initial cost to the cash inflow from this machine. All right, so let's do another knowledge check. So the average rate of return is sometimes referred to as the investment rate of return, the cash payback method, accounting rate of return, or the net present value method. So the average rate of return is referred to as the accounting rate of return, and I think it was mentioned in the previous slides. So the accounting rate of return is the other name for the average rate of return. The average rate of return, sometimes called the accounting rate of return, it measures the average income as a percentage of average investment. All right, so let me stop here. In the next video, we're going to be going over the methods using present values.